Welcome you all for the session. I just wanted to know, am I clear and audible? Please write yes in the chat box if you could hear my voice clearly, because today's a couple of students said that they were unable to hear my voice clearly. Just please let me know. Mirzaman, Taha, Main, Shapar, and all those who are here, just let me know if you can hear me uh, clearly. Okay, we'll talk about the books of prime entry. Anik, especially for you, Anushe, books of prime entry. There are 6 books of prime entry, right? Number one is Revenue Day book. What does it records, Anik, Anushe? It records on goods sold on credit, right? Goods sold to credit customers. Then Purchase Day book, goods purchased from credit suppliers, credit purchases. Then Revenue Returns book, then Purchase Returns book. Now, what Revenue Return books records? Goods returned by credit customers. What Purchases Return book records? Goods returned to credit suppliers. And then we have Cash book that records all the cash and bank transaction. Now, keep one thing in mind. Revenue Day book records only one thing and nothing else. What is that one thing? Credit sales, right? Credit revenue, goods sold to credit customers, right? Whereas Purchase Day books again record only one thing, and that is goods bought on credit, goods purchased from credit suppliers. Return inwards or Revenue Return Day book records goods returned by credit customers, only one thing, right? Return outwards or purchase return books records only goods returned to credit suppliers. Cash book records two things, cash and bank transactions, including discounts, right? Whereas all the other transactions, no matter what the transaction is, right, all the other transactions fall in journal, right? So we have 6 books of prime entry: Revenue Day book, Revenue Return book, Sales Day book, sorry, Purchase Day book, Purchase Returns book, Cash book, and then the last one is journal, right? So anything that is not recorded in the above 5 are recorded in journal. Let's see what is my MCQ there. And I'm expecting a correct answer from all of you. Oh, excellent, Anushe. Great, Shapar, Taha, Mirzaman. Excellent. You know, Anusha, I'm glad you are now getting it and getting it very well. You know, uh, Ta, could you explain how is it the answer that you have come to? I'm turning your voice on. Yes, Ta.
So can you hear me?
Yeah. Listen, those who have given incorrect answer, please listen what is he saying.
So which item is entered in the general journal?
Right.
Option A is a cash discount given to a customer. This is recorded in the cash book.
That's
And then
correct.
option B is the correction of an error made in the ledger. So this will be recorded in the general journal
Right.
because
What about C and D?
it does not concern any of the above books, any other books.
Right.
And then we have C, sale of an asset for cash, which will be recorded in the cash book.
That's
And
correct.
the withdrawal of cash for private use by the owner will also be recorded in the cash book.
Great, Ta. Thank you very much. I hope this is clear for those who have not given the correct answers. Right. Okay, let's move on to the next one. That's interesting. You have to calculate the expense for the period. Keep in mind that your year starts on January the 1st and it ends on December the 31st, right? And you're making two different payments. Uh, One payment you made in 2014, and that is a 4,000, and the date of payment was April the 1st. So from April the 1st, it will last to March the 31st, 2015. And in April the 1st, 2015, you made another payment for 12 months, lasted till March the 31st, 2016. And you are supposed to calculate the expense for the period 2015, January till December, right? You may make a ledger, you make add and subtract, whatever, try and do it, uh, keeping in mind January the 1st, 2015 till December the 31st, 2015. Do the calculation, use your calculators. I'm waiting for your reply. Uh, okay, I'm looking for answers. I just got two answers, and one of them is correct. I'm waiting for more answers. Elia, Shapar, Mirzaman, Abira, Main. I'm waiting for answers. Okay, Shapar, I'm switching on your voice. Your answer is correct. Could you explain it to the other fellows? Shapar, can you hear me?
Yes, sir, I can hear you now. All
Yeah,
right.
that's
So basically, the company is paying rates in advance each year. So starting from 1st April, it's paying the 4,000 on 1st April 2014, right? So if we
that's correct.
divide the 4,000 into 12 months, we
Right.
can calculate that how many months are like extra paid. For example, when this your accounting year starts on 1st January, ends on December. So starting from January, and since the rates are being paid on April, यानी कि मार्च तक का जो account the rates are already paid. Starting
Great.
from
That's
April, that's when you start calculating the current year's के नाम है rates. So the extra months in 2015 become so January, February, and March. These 3 months are basically paid in advance in 2014 for the year 2015. You
great.
divide
Great.
4,000 by 12 and you get, I suppose, if you divide 4,000 by 12,
And
you
multiply it
get,
by three.
and multiplied by 3 months, you get
You get one.
1,000.
That's correct.
And for now, this is only paid for the 3 months. We have to calculate the rest of the months as well to find a total of current year income statement value, which is 2015's value. Since we paid to for 4,800 on April 2015, we can divide it by 12 again and multiplied it by 9 months,
Right.
and you get the value 3,600. You add the previous 1,000 and 3,600 together and you get the answer 4,600, which is the C option.
Wonderful. I did almost the same thing what Shapar just said. Let's see my answer. Right. I did exactly the same thing what Shapar just told you people. That 4,000 is paid for 12 months, right? I divided it by 12 and multiplied by 3. Why multiplied it by 3? Because January, February, and March of 2015. You paid on April 1st, 2014, and it will last till March 31st, 2015. So January, February, March of 2015. And then as Shapar said, like 4,800 into 9 over 12 this time. Why 9 over 12? Because from April till December 2015, there are 9 months. And I got the answer 3,600. 1,000 plus 3,600 is 4,600. Let me know, Anushe, is it clear, Anik, Mahin? You know, I don't mind repeating it again. I did exactly what Shapar did. It's more maths than accounting, and I added them up, as she said, 4,600. Okay, this time, you have to consider which one is not a liability, rather which one is a current asset. Other receivable means it's current asset, which you can demand from somebody. Other receivable means something that you can demand. that is receivable, that you can ask the people to give you back, right? Uh, there are expenses in it, there are liabilities in it, and there's only one item which is an asset. Try and find out, and I would be glad to open the voice, whoever did it first. Okay, we go one by one. Leave the first one. Second is a liability. Do we agree upon that? You received income in advance. So income in advance is a liability. Repayment of loan is decrease in liability, right? Commission of last month paid is another decrease in liability. You're paying off your liability. So loan, repayment of loan is paying off your liability, right? Commission paid for last month is paying off your liability. The first one is basically an asset. Why an asset? You're paying it advance to your suppliers. They have not provided you the goods. You have paid them the amount of money, right? And that is your advance payment, not advance receipts. Advance receipt is a liability. Advance payment is an asset. It's prepaid, paid in advance. Like you pay for your prepaid Jazz card or prepaid Varit card or prepaid Uphone card or prepaid Telenor card, that is your asset. You paid in advance, right? So my answer is A, deposit with suppliers 6,500, right? Please let me know if it is clear or not. I would like to explain it if it is not. Any amount that you paid in advance is an asset, a current asset in most of the cases. Okay, Shapar, brilliant. I saw your answer late, but it is well, good. Otherwise, I would have opened your voice for explanation. Okay, now, you know what is working capital? That is current assets minus current liabilities, right? So if there is an increase in current asset, your working capital will increase. If there is an increase in current liability, your working capital will decrease. Inverse relationship है working capital का liability से. If your current asset will decrease, your working capital will decrease. Direct relationship है. If your current liability will decrease, your working capital will increase. Now look at these and find out in which case there is no change in current assets or current liabilities, or perhaps current assets and current liabilities are changing with the same amount, right? If there's only change in current asset, working capital will change. If there's only change in current liability, working capital will change. Working capital will not change if there is no change in current assets and current liability. Or working capital may not change, or will not change if both current assets and current liabilities are increasing with the same amount, right? I'm looking for the answer now. Elia, correct. Ta, correct. Elia, can I switch your voice? Try and explain that one by one.
Sir, can you hear me?
Yeah, a little louder, please.
So, sir, in uh, part A, disposal of a non-current asset. If we dispose a non-current asset, cash, we will gain cash from it, so it will increase the current assets. So this is
Excellent.
not
This is
in
not the
part
option.
no. In
Okay.
in B, we are issuing shares for cash. This will also increase cash, which is in current asset. So this is not an option also.
Right, because even current assets will go up and the working capital
Yes,
will go up, right? So that's
yes.
not an option. That's correct.
And
Before you move on to C, can you move on to D first?
yes, yes. In D, we are writing off an irrecoverable debt, which is trade receivable, and we are decreasing current asset. So working capital will change.
Right. If we decrease current asset, working capital will also go down.
And in C, which is the correct answer, we are purchasing goods for resale on credit. We are purchasing inventory,
Right.
which will increase the capital, which will increase the working capital. But we are purchasing them on credit. So the capital current liability will also increase by the same amount. So it will leave the working capital unchanged.
Right. Great, Elia. Thank you very much.
Thank you, sir.
See, as Elia said, uh, inventory will increase, current asset will increase, but corresponding current liability is also increasing. So increase in current assets and increase in current liability with the same amount will have no change in working capital, right? Great, Elia. Thank you very much. Anusha, is it clear? Mirzaman, Mahin, Abira. Okay, great. You got the correct answer. Let's move on to the next question. And it's an easier one, right? Again, back to books of prime entry, right? We have 6 books of prime entry: revenue day book, revenue return book, purchase day book, purchase return book, cash book, and the journal. All you have to do is to find out where are we recording the transactions. Oh, please, I'm looking for answers. It has to be quick. Quick, Alia, Shapar. Quick, Main, Abira. Quick, Anushe. Okay, Ta, I'm switching on your voice. Could you please explain? Right, and start with B, C, and D. Discuss the other options first. You will come back to A later.
So basically, sir, in this question, Ryan sells goods on credit to Sumit, and Sumit also supplies goods. So we're making a contra entry here,
Okay, we are making a contra entry here, correct?
and that will not be in any of the books, not the sales journal, because in the sales journal we record sales on credit,
That's correct.
and so it, and not even in the purchases journal, because we record purchases on credit in the purchases journal. So it will be in the general journal, and both the books, Ryan's and Sumit's.
Okay,
So
great.
our answer is A.
Thank you. Thank you, Ta. Okay, so what Taha said is both the parties are going to record in journal, right? There's no point recording it in say revenue journal or purchase journal. It has to be journal, right? Revenue day book records only credit sales, purchases day book records only credit purchases. And this is not purchase or sales, this is what we call contra set off, right? Mirzaman, Main, Anushe, Anik, let me know. Okay, good, Shapar. I saw your answer late. Abira, that's correct. I saw your answer late too. Coming back to you, Anushe. I'm switching your voice on. Um, the other people can answer this question. I'm just switching Anushe's voice. I have to answer a question. Uh, Anushe, could you repeat the question, please?
Hello, sir. Can you hear
Yes.
me?
Yeah, I can hear you very clearly.
My question is that Ryan is selling his goods to meet on credit, right? So he will
That's
record
right.
his sales in the sales day book.
That's correct.
But
That's
why
correct.
are we? But why is the answer option A?
Okay.
That
Now the thing is, yeah. I mean, excellent, and I am glad that you asked this question. You know, he's selling goods to Sumit, right?
yes,
And he's buying goods from Sumit as well, right?
yes,
So when he will sell goods to Sumit, he will record it in the revenue day book,
yeah, okay.
and when he will buy from Sumit, he will record them in purchase day book.
Hmm.
That's correct,
Yes.
right? And I agree with the statement that you gave that it should be recorded in the revenue day book, right? But
Hmm.
if can I just go back to the question and show you the question,
Yeah, sure.
the previous question?
Yes,
It
yes.
says, yeah. Now, if you read it, Anusha, what the question says,
Um, Ryan sells goods on credit to Sumit. Sumit also supplies goods to Ryan. It
right?
is
Meaning Ryan also
decided,
purchasing her, right?
yeah. It
Okay,
is
move on.
decided to make a set of the purchases ledger and sales ledger balances.
Now they're not talking about sales and purchases. They're talking about contra set off. Now, sales and
Oh,
purchases have already been recorded, right? What they are
yeah.
going to do here is to set off. Like, I sell goods to you and I buy
Mm-hmm.
goods from you, right? When
Okay.
when I sell goods to you, I record it in revenue day book,
Yes.
right? When I buy goods from you, I recorded them in purchase day book,
Purchase. Yes. Okay.
right? And then suppose I sell you goods for 1,000 and you sell me goods for 2,000.
Hmm.
So rather I ask you 1,000, 1,000 and I give you 2,000. I simply set off 1,000.
Yes.
So this is what we are doing here. We are writing contra set off. We are not recording the sales at this point in time. Sales has already been recorded. We are not recording the purchase at this point in time. Purchase has been
Oh,
recording,
it
right?
asks in which books of prime entry is this set of recorded? Oh, okay.
That's right. That's right.
I just said. Okay, sir.
Great.
Thank you,
Is it okay?
sir.
Welcome. No problem. You're always welcome. Okay, moving to the question we were doing, and I'm looking for answers from you people. Uh, I'm waiting for more answers. I've got two answers, both of them correct. The first one was Shapar. Shapar, if I open your voice, could you please explain this to the other fellows?
All right. So in this question,
Yeah,
basically, the business is paying an advertisement expense, which
right.
is supposed to be 5,250, but
Okay.
it has been overstated by 500, and the wrong amount has been entered in your financial statement, which is income statement.
Okay,
So when
that's
you're
correct.
going to, yeah, so when you're going to correct this mistake, what we're going to do is we're going to be subtracting, or basically opposite entry, which is going to be, we are going to be subtracting 500, and
From expenses.
now from our expenses. Now expenses have an inverse relationship with our profits, and
Great.
since expenses have been decreased by 500, our profit will be now increasing by 500 since we've
That's right.
understated the expenses now. And in the net current assets, what will happen is that 500, which was a prepayment for the next year, that means prepayments are those things that we have already been paid for and we haven't had received the services
Services.
for it yet.
Right.
So basically, since we've paid for it, we haven't had the services. This is going to be our asset for the upcoming year, and we are going to be. This is how our net current asset will also increase by
Great.
500.
Wonderful. Wonderful. I did exactly the same thing. Let's see my answer for this. I did exactly what Shapar said. 5750 I've charged to my income statement, right? That includes 500, which is prepaid. which is paid in advance, paid for the next year, as Shapar said, right? So my actual expense of the period is 5250. So if your expense goes down, your income goes up. Expense has inverse relationship with income. So if your expenses are going down, your income is going up, right? Your income will go up and your expenses are going down, number one. Number two is that prepaid expense is an asset, right? We have discussed it multiple times that prepaid expense is an asset. So if it is prepaid advertising is an current asset, and there we are. Ta, is it okay with you? Elia, you got the correct answer. I'm Amir. Let me know if it is okay with you, so I can move forward. Okay. In this particular case, there are two expenses and there are two income. In fact, this is one of the repeated MCQs, right? Try and answer this. I'm waiting for the answer. Two expenses and two income are two asset items, and you have to add the two expense accrued liabilities. Two liabilities you have to accrue the two liabilities and two assets. So you have to add the two liabilities to tell the correct amount. Okay, Dua, that's correct. Dua, shall I open the voice? Would you like to explain it? I'm switching your voice on.
Sir, can you hear me?
Yeah, I can hear you very well.
Okay, sir. So accrued expense is a liability and prepaid income is a liability. So we are going to add 9,350 and 32,650. So the answer is 42,000. The rest are asset, so we're not going to add them. So the answer is
Great.
option C.
Wonderful. You know, as Dua said, you are adding up accrued expenses and you are adding what you are adding again, Dua? What's the second thing?
Prepaid income. Prepaid
Prepaid,
income.
right? So prepaid income and accrued expenses. Thank you very much, Dua. That's great. So the answer is 42,000, right? Okay, let's move on to the next one. This is again one of those repeated one that has come in another examination question, right? All those who are repeated like here are, those who have come more than once, the same number by number, word by word, letter by letter, MCQ repeated by the examiner, right? uh, This is based on one of those concepts, you know. And if I am very precise, to be precise, it's consistency concept. Think about consistency concept and answer the MCQ. Okay, great. Most of you are right. Okay, though I'm switching on your voice, I just want you to explain the correct option, just the correct option.
Can you hear me, sir?
Yeah, I can hear you very well.
Okay, sir. So changes in depreciation method means that you're no longer following the consistency method. Hence, the true and fair image is not shown. So the answer is option A.
Right, great. As Dua said, we are not following the consistency concept, so it can't be true and fair picture of the company's performance. Thank you, Dua. Let's move on to the next one, which is perhaps very easy now, because this is the third of its type uh, we have done even today, right? Where are we going to record the transaction, right? And I want this time all correct answers. Okay, I'm glad. 100% correct answer. All of you gave the correct answer, right? Let's move on to the next one, where you have to tell what amount will be transferred to income statement. There is some some interest receivable at the beginning of the period, some interest receivable at the end of the period, and some interest received during the period. What is the amount to be recorded in the income statement, transferred to the income statement? Okay, take your time. Perhaps this would be our last question, so I want you to give yourself time and let me know the answer. Okay, Abira, your answer is correct. Would you like to explain it to us? I'm switching your voice on. Abira, can you hear me?
Sir,
Abira,
can you hear me now?
I can hear you now. Great.
Okay, sir. 1 minute. Sir, the company received 8,800 of interest and 700 was sorry, sir. 700 was due at the beginning. That means that
That's it.
we have to minus 700 from 8,800, which
That's
makes it
correct.
8,100, and
Right.
850 was due at the end of the period. So we will add that amount
Right.
and it's 8950 and
That's
it will
correct.
be debited to the account.
Brilliant. Excellent. I did the same thing. I just did it by means of T account. Let's see my answer. What Abira said, I did exactly the same thing, but I made an account rather than simply adding and subtracting. My opening asset was 700 brought down. My closing asset was 850 carried down. And during the period, I received cash of 8,800. So the amount that is transferred to income statement is 8950, and that is on the debit side of the interest receivable account, right? So I repeat, rather than adding and subtracting, I made a T account and I added and subtracted there. So what I did, I added 850 and 8,800, right? That gave me 9,650, and then I deducted 700 from it to arrive at 8950, right? Uh, is it okay, Elia, Shapar, Taha? Let me know, Mir Zaman, you know, Main, Anik. Just let me know. Otherwise, Dua, I don't mind explaining it again. Okay, thank you very much for joining me today. We'll have our next class on Tuesday, uh, that is October the 30th, right? Same time. Thank you very much for your time and your efforts and your participation, and especially those of you who explain it here to other classmates. I really appreciate their efforts. Thank you very much, and Allah Hafiz from my side.